Hi there, my name is Ashley Micciche, CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. Now today it's our monthly economic and market update. I have here with me David Wilson, our founder and president, who also happens to be my dad. So why don't you start off with kind of bringing us up to speed on where things are in the economy, how the economy's doing, how the stock market's doing, how the bond markets are doing.
Okay. Well, I think the overriding issue that everybody is hearing about is this inverted yield curve. You know, what the heck is the inverted yield curve? That means that the short rates, like the 2-year treasury, has a higher yield than the 10-year treasury. There's two big problems with it. First, it's got to be continuous for like 3 months. So like today, early September, it isn't inverted. Mm-hmm. A couple days ago, it was inverted. And then before that, it was inverted and then goes out of it. So basically it comes and goes. The other thing that's going on is that these central banks around the world are influencing the short rates. They can't really control the long rates, but they can influence the short rates.
People think that the Fed and all these central banks around the world, they control all interest rates, long-term, short-term, etc. But they only control the very short-term, very, very short-term, like the overnight rate for banks. So, but what's happening, I know you wrote about this in the newsletter, is part of the reason what's driving the rates down, especially on the long end, is that around the world, how many $trillion?
It's not 17 trillion, although it changes from day to day, but it's 17 trillion or so.
$17 trillion around the world is paying negative interest rates. So last month we talked about Germany.
That's basically where you put your money in the bank and you're paying the bank to hold your money. Seems pretty crazy to me.
Yeah. So what's happening is that all these investors around the world are looking to the U.S.
because we're still paying, 1.6% on a 10-year treasury.
Right.
That's better than a minus 0.7 in a German Bund.
Yeah.
So where are you going to put your money? Here.
Right. And so the problem, so that's also been like driving interest rates down because demand is high, so it drives up the price and the yield goes down. So there's a lot of factors, and I think if you just look at the whole inverted yield curve through, like tunnel vision, then maybe on the surface it looks like, oh no, a recession is coming, this is a warning sign. But like you said, there's some other factors right now influencing that. So it's not necessarily the flashing red light indicator
I don't think it
has been in the past.
I think the key right now with our economy is the consumer spending is growing at a 4% annual rate. Wages are going up at a 5% annual rate. The economy grew a little bit over 2% in the second quarter. I think we're fine. Yeah. And we're kind of the beacon on the hill for the rest of the world in terms of our economy. And so I think the biggest thing that we have to fear is fear itself. And if people keep beating the drums and they're so fearful and they're afraid of their shadow, we could push ourselves into a recession, but we don't see it right now.
Your point about the consumer is really important because what percentage of U.S. economic growth GDP does the consumer make up?
I thought it was 70%.
Yeah.
Or more, or if not more.
So it's the consumer is this huge driver of economic growth, and so if their wages are going up, if consumer spending is growing, it's a good sign. Now it may not, I don't know if it's a leading indicator or anything, but it's a good sign that perhaps a recession isn't looming out there. Now, what I would say, and you wrote about this in the newsletter too, is that, we're still going to have a recession at some point. We don't know when it is, but we don't believe that a recession is imminent and, it's just around the corner. And we could even be here talking this time next year and still not have fallen into a recession. Right. So there's no strong reason to believe that we're going to fall into a recession in the near future, especially if Trump and China can come to some sort of agreement, which may or may not happen.
We don't know.
Okay, so we sort of talked about what's going on with the economy. Let's talk, and bond markets too. Let's talk about stocks. Our stocks are still pretty close to their all-time highs, but they've pulled back a little bit. So where are we at with the stock market, and where do you think we're going from here?
Well, let's just start off historically. September is the worst month of the year.
Okay.
But since China and the U.S. are going to meet in October, that's kind of, changed everything again. So instead of everybody being so negative, it almost provides kind of a floor into the market because, they're going to meet, that's got to be positive, right? The other thing is that a very rare point in time where we're at right now is that stock yields, I think on over 60% of the S&P stocks have a higher yield than the 10-year treasury. So that's very rare moment. And it goes back to investors around the world with negative interest rates and low yields. They are looking for yield. Where do they find it? And so I think it makes rising dividend stocks very attractive.
How does this impact you? That's why we create these videos. That's why we're doing this, so that you have a better understanding of how you can connect all the dots between what's going on in the world and what's going on with your portfolio and how that impacts you. So let's talk about some areas of opportunity, maybe some areas of risk as well, and areas that we're avoiding, areas that we're emphasizing, and how we're managing clients' money in this environment.
So one of the things that we're doing right now is after the market hit new all-time highs back in July, we're using the now that we're almost approaching the all-time highs again, we're only 1.5% away, to look at people's allocation and seeing if it is appropriate, if it needs to be, if we need to pull a little bit off the table. It's not that we're scared about the market or anything. It's just being prudent. And so that's a strategy that we're doing at this time. And the other is I think one has to be careful if one goes into long-term bonds. Whenever interest rates do start to go back up, you want to be careful being out too far. I don't mind being out 5, 6, 7 years, but I think anything beyond that, it does concern me if interest rates do start to go up, because we're starting from such a low level that would affect values.
The short term being more shorter term on the bonds, dividends, or not dividends, but fixed income in your portfolio is meant to provide income, but the other core purpose of the fixed income is provide stability to the stock portfolio that's going like this all the time. So we don't want the bond portfolio to be doing this too. We want it to be relatively stable. And so by being shorter term and emphasizing that, like we have done for years and years and years, I mean, as long as I've been around.
Yeah, and here's the other thing that I think of part of the fixed income portfolio is a source of capital that we can use if there's an opportunity. At Christmas time, the market was down 20% just over the course of a couple months. That would have been a great moment that you could have moved some money from the fixed income side and bought stocks very cheap. Those are the kind of opportunities that occur every now and then. You just don't know when they're going to happen. If you have some powder dry, if you don't have everything in the market. And if you look at the studies of performance, versus 100% being in the market versus, 60-40 allocation, the returns aren't that much difference for the amount of risk you're taking. So I think it's just being prudent.
Yeah. You touched on this a little bit, but dividend stocks. So how we view dividend stocks is no matter what age or stage in life you are, the dividend stocks should be the absolute foundation core of your portfolio, no matter what. And lately, the last few years, with a lot of these tech companies being very prominent and popular, dividend stocks have, especially with the market being so strong too, because a lot of people use dividend stocks for protection. They want to buy a safe, relatively well-known, stable business, but they kind of lose those principles after 10 years of a bull run in the market. And so dividend stocks haven't been as sexy as they've been in the past. Dividends, I think, are at an interesting point now where they really present a strong case for both the income that they're providing now that they're yielding more than a lot of the treasuries out there, and also the protection that they offer on the downside when we hit rough patches in the market.
There's another area that I think we should talk about, and that is value stocks. What we mean by value, companies that are trading at a significant discount to what they would be worth if they were bought out. So if they're worth $100 if they were bought out and they're trading for $75, and then they have a dividend and they have a solid business and good management, that's a good value stock. So they're out there, they're all over the place, but markets kind of, like I said, neglected them.
Yeah.
And that's an area of focus too. So those are some dividends, and I think value stocks would probably be a good place to park invest some money in equities, not park.
Thank you so much for watching our monthly economic and market update for the month of September 2019. My name is Ashley Micciche, here with our founder and president, David Wilson. And did you know, if you did not know this, we put out videos every single week. And we do this video, this market update, once a month. So be sure to like, comment, and subscribe below, and hit that little alert button too, so that you're notified every time we put out new videos, which we do here about every Tuesday here at True North Retirement. Thank you again so much for watching, and I will see you next week.
I think the market has to fear itself. Right now.
Who said that originally?
So
people are like, whoa! We should get a drum so that we can
boom, boom. I need a drum.
During the Great Depression.
Not Eleanor, somebody out there. Don't trip. The only thing to fear is fear itself. However you say it. Don't edit that out, please.
My name is Ashley Micciche, here with our CEO.
CEO.
You're not.
I'm the CEO. Now I'm the CEO. Hey, I moved up, people. This is Ashley Wilson. I'm the CEO of True North.